Invest Like a Pro, Mastering the Basics of Investments and Wealth Building. This audiobook is your essential guide to achieving financial success. Whether you're a beginner or looking to refine your investment strategy, this audiobook covers everything you need to know about smart investing. Learn how to grow your wealth, understand financial markets, and make informed decisions with confidence. From stocks and real estate to passive income strategies, this audiobook breaks down complex financial concepts into simple, actionable steps. Don't leave your financial future to chance. Start building wealth today. Like, share, and subscribe for more powerful financial insights. Chapter 1: Understanding Money and Wealth. Money has always been a central part of our lives. Whether we like it or not, financial security plays a major role in our happiness, stability, and future. Yet, many people go through life struggling with money because they were never taught how to manage it wisely. Understanding money and wealth isn't just about numbers. It's about mindset, habits, and long-term vision. The first step toward financial success is knowing the difference between income, savings, and wealth. Many people confuse these three concepts, believing that a high income automatically translates to wealth. While earning a good salary is important, it does not guarantee financial security. Income is simply the money you earn, whether through a job, a business, or investments. Savings, on the other hand, represent the portion of that income you set aside for future use. However, true wealth goes beyond income and savings. Wealth is the ability to sustain your lifestyle, even if you stop working. It is built through smart investments, assets that appreciate over time, and financial discipline. To truly build wealth, you must understand the psychology of money. Our beliefs and emotions surrounding money shape the financial decisions we make. Some people grow up thinking money is scarce, leading them to develop a scarcity mindset. They fear spending, avoid investing, and constantly worry about not having enough. Others believe money is meant to be spent freely, leading to financial instability. The truth is, your mindset plays a huge role in your financial journey. A healthy relationship with money means understanding its purpose, not as something to hoard or waste, but as a tool to create opportunities and security. Shifting from a scarcity mindset to an abundance mindset allows you to make wiser financial choices. When you believe in your ability to generate wealth, you begin to see opportunities where others see obstacles. One of the most powerful yet overlooked secrets of wealth building is the power of compounding. Many people underestimate how small, consistent actions can create massive financial growth over time. Compounding is what happens when your money starts earning money on its own. Imagine planting a tiny seed. At first, it seems insignificant, but with time, sunlight, and care, it grows into a towering tree. The same principle applies to your finances. If you invest a small amount of money regularly and let it grow, the interest earned on your investment begins to generate its own interest, creating exponential growth. The earlier you start, the more time your money has to grow. This is why time is your best friend in wealth creation. Even small investments made early in life can result in substantial financial freedom in the long run. While learning how to grow wealth is important, avoiding financial mistakes is just as crucial. Many people unknowingly sabotage their financial future due to poor money habits. One of the most common mistakes is living beyond one's means. In today's world of credit cards and easy loans, it's tempting to spend more than you earn. But relying on debt to maintain a lifestyle you can't afford only leads to financial stress and instability. Another major mistake is neglecting to save and invest. Many people think they will start saving when they earn more, but in reality, if you don't build the habit now, it only gets harder later. Procrastination is one of the biggest enemies of financial success. Investing without knowledge is another costly mistake. Some people jump into investments they don't understand, hoping for quick returns. This often leads to losses and discouragement. Before putting your money anywhere, it's essential to educate yourself and make informed decisions. Similarly, Failing to diversify investments can put you at high risk. Putting all your money into one stock or one type of investment can lead to devastating losses if the market shifts. Wealth building is not about luck. It is about understanding money, cultivating the right mindset, and making smart choices consistently. The journey to financial freedom starts with financial literacy, learning how money works, making informed decisions, and adopting habits that support long-term growth. The sooner you take control of your financial future, the greater your chances of achieving lasting wealth. The next step is diving deeper into strategies that will help you invest like a pro, ensuring that your money is always working for you, even while you sleep. Chapter 2: The Basics of Investing. Investing is one of the most powerful tools you can use to build wealth and secure financial freedom. Yet, for many people, the word investing sounds complicated, risky, or even intimidating. The truth is, investing is simply the act of putting your money to work so it can grow over time. Whether it's stocks, real estate, bonds, or even your own education, investments have the potential to generate returns that help you achieve financial stability and long-term success. At its core, investing is about making your money work for you, rather than just letting it sit in a bank account. When you invest, you are essentially purchasing assets, things that can increase in value over time. Unlike saving, which involves storing money safely for future use, investing focuses on growth, often with the goal of beating inflation and maximizing returns. Understanding the difference between saving and investing is crucial. Saving is a habit that ensures financial security. It is like keeping an emergency fund for unexpected situations, such as medical expenses or job loss. Investing, on the other hand, is about growing wealth. It carries some level of risk, but it also offers greater rewards. While saving money in a bank account is safe, the interest earned is usually minimal and may not even keep up with inflation. Investing, however, allows you to build wealth through compounding returns and market appreciation. One of the most important factors in investing is risk tolerance. Every investment comes with a certain level of risk, and understanding how much risk you can handle is a key step in making smart investment decisions. Some people are naturally comfortable with high-risk investments because they have a long time horizon and can afford to wait for the market to recover from downturns. Others prefer lower-risk options because they need stability or are closer to retirement. Assessing your risk tolerance involves understanding your financial goals, time frame, and personal comfort level. If the thought of losing money in the stock market keeps you awake at night, you might lean toward conservative investments like bonds or index funds. However, if you're willing to ride out the ups and downs for the potential of higher returns, you might consider stocks or real estate. The key is to find a balance that aligns with your financial aspirations and emotional well-being. When it comes to building wealth, one golden rule stands out. Start early, stay consistent. The earlier you begin investing, the more time your money has to grow through compound interest. Compounding is the process where your investments generate earnings, and those earnings are reinvested to generate even more earnings over time. This snowball effect can turn even small investments into significant wealth over the years. Many people believe they need a large sum of money to start investing, but that's not true. With today's technology, anyone can begin investing with small amounts. The most important thing is consistency. Even if you can only invest a small portion of your income, doing so regularly over time can lead to substantial results. Imagine planting a tree. At first, it may seem small and insignificant, but with patience and consistent care, it grows into something strong and enduring. One of the biggest mistakes people make is waiting too long to start investing. They assume they'll begin once they earn more money, once they understand the market better, or once the right time comes. The reality is, there's never a perfect moment to start. The best time to invest was yesterday. The second best time is today. By taking action now, no matter how small, you set yourself up for a more secure financial future. Another key aspect of investing is staying the course. The market will go up and down, and sometimes It can be tempting to panic and sell when prices drop. But history has shown that markets recover over time. Successful investors don't react to short-term fluctuations. Instead, they stay committed to their long-term strategy. Think of investing like a marathon, not a sprint. The ones who stay patient and consistent reap the biggest rewards. Investing is not just about money, it's about mindset. A wealth-building mindset is one that embraces learning, patience, and discipline. The more you educate yourself about investments, the more confident you become in making informed decisions. Take time to read books, follow financial experts, and learn from successful investors. The more knowledge you gain, the better equipped you'll be to navigate the world of investing with confidence. Chapter 3: Types of Investments and How They Work. Investing is not just about making money. It's about making your money work for you. The key to financial growth is understanding the different investment options available and choosing the ones that align with your financial goals. Many people shy away from investing because they think it's complicated or risky. But the truth is, once you understand the basics, you can take control of your financial future with confidence. In this chapter, we will explore 4 major types of investments: stocks, bonds, real estate, and alternative investments, so you can decide which ones fit best with your strategy. When you hear about the stock market, it may seem like a chaotic world reserved for financial experts and Wall Street professionals. However, stocks are simply pieces of a company that anyone can own. Buying shares in a company means you become a part owner of that business. When the company does well, its stock price often increases, allowing you to sell your shares for a profit. Additionally, some companies distribute a portion of their earnings to shareholders in the form of dividends. Stock prices fluctuate daily based on factors such as company performance, industry trends, and overall market conditions. While investing in stocks carries risks, it also offers significant rewards. Historically, the stock market has outperformed many other types of investments over the long term. One of the most effective ways to mitigate risk is through diversification. Owning shares in multiple companies across different industries to protect yourself from individual stock downturns. For those who prefer a hands-off approach, mutual funds and exchange-traded funds, ETFs, allow investors to buy a collection of stocks in one purchase. This strategy provides exposure to the stock market while reducing the risks associated with owning individual stocks. While the stock market can be volatile, disciplined investors who stay the course tend to see growth over time. If stocks represent ownership, bonds represent lending. When you purchase a bond, you are essentially lending money to a company, municipality, or government in exchange for regular interest payments and the return of your original investment after a specified period. Bonds are considered a more stable investment compared to stocks, as they provide fixed income and lower risk. Government bonds, such as US Treasury bonds, are considered some of the safest investments available. Corporate bonds, on the other hand, offer higher interest rates but come with a higher level of risk depending on the financial health of the issuing company. Municipal bonds, issued by local governments, often provide tax advantages, making them attractive to certain investors. Bonds are an excellent option for those looking to balance the risk in their portfolio. While they may not provide the same high returns as stocks, they offer security, predictability, and a steady income stream, making them a great choice for conservative investors or those nearing retirement. By combining stocks and bonds in your investment strategy, you can achieve both growth and stability in your financial journey. Real estate has long been considered one of the most reliable ways to build wealth. Unlike stocks or bonds, real estate investments provide tangible assets that can appreciate over time while generating passive income. Investing in property can take several forms, including rental properties, commercial real estate, and real estate investment trusts, REITs. Owning rental properties allows investors to earn consistent income while benefiting from property value appreciation. By renting out a home or apartment, landlords receive monthly payments that can cover the mortgage and generate profit. Additionally, Rental properties offer tax advantages such as depreciation and deductions for expenses related to property management and maintenance. For those who want to invest in real estate without the hassle of managing tenants, REITs provide an alternative. These are companies that own and manage income-generating properties, such as apartment buildings, office spaces, and shopping centers. By investing in REITs, individuals can gain exposure to the real estate market without directly owning physical property. While real estate requires a higher initial investment than stocks or bonds, it offers long-term benefits including cash flow, tax advantages, and appreciation. However, investors should be aware of the responsibilities associated with property ownership, such as maintenance, tenant management, and market fluctuations. With careful planning, real estate can be a powerful tool for financial growth and passive income generation. Beyond traditional investments, alternative assets provide additional opportunities for wealth building. These investments include gold, cryptocurrency, commodities, hedge funds, and private equity. While they often carry higher risks, they can also offer significant rewards and serve as a hedge against inflation and economic downturns. Gold has been a store of value for centuries and is often used as a safe haven investment during times of economic uncertainty. Unlike paper currency, gold retains its value and can act as a hedge against inflation. Many investors allocate a small portion of their portfolio to gold as a form of financial security. Cryptocurrency, a more recent investment option, has gained popularity due to its high growth potential. Digital currencies like Bitcoin and Ethereum operate on decentralized blockchain technology, providing an alternative to traditional financial systems. While crypto markets are highly volatile, early adopters have seen substantial returns on their investments. However, due to regulatory uncertainty and price fluctuations, investing in cryptocurrency requires careful research and risk tolerance. Other alternative investments, such as commodities, oil, natural gas, agricultural products, and private equity, investing in private companies, provide diversification options for experienced investors. These assets can be complex and require specialized knowledge, but they can also yield impressive returns when approached strategically. Chapter 4. Building a solid financial foundation. Imagine you are about to build a house. Would you start by designing the roof or picking out furniture? Of course not. The first step is always to lay a strong foundation that can support everything that follows. The same principle applies to investing. Before you start putting money into stocks, bonds, or any other investment vehicles, you need a solid financial base. Without it, even the best investment strategies can crumble under the weight of poor financial habits. One of the most crucial aspects of building this foundation is budgeting. Many people underestimate the power of a well-structured budget. It is not just about restricting your spending, but about gaining control over your finances. Budgeting helps you understand where your money is going, ensuring that you live within your means and have enough to allocate towards investment in the future. Think of your budget as a roadmap that guides your financial decisions. Without it, you may find yourself lost, unsure of whether you are saving enough or spending too much. A good budget provides clarity. It allows you to separate needs from wants, ensuring that you prioritize essentials such as housing, food, and transportation before indulging in non-essentials. When you have a budget in place, you can identify areas where you might be overspending and redirect that money towards savings and investments. More importantly, it helps you prepare for unexpected expenses so you are not forced to dip into your investment funds when an emergency arises. Speaking of emergencies, one of the most important financial safety nets you can have is an emergency fund. This is your first line of defense against life's unexpected challenges. Imagine losing your job, facing a medical emergency, or dealing with a major car repair. If you do not have money set aside for such situations, you might be forced to rely on credit cards or loans, which can spiral into long-term debt. An emergency fund ensures that you can handle financial surprises without derailing your investment plans. Many financial experts suggest having at least 3 to 6 months worth of living expenses saved in an easily accessible account. This might seem like a lot, especially if you are just starting out, but it is achievable with consistency. Start by setting small goals. Even saving a few $100s at first can provide a cushion against minor financial setbacks. As you continue to build this fund, you will gain peace of mind knowing that your investments remain untouched and continue to grow even during tough times. While an emergency fund is crucial, it is equally important to address high-interest debt before diving into investments. Think of debt as a hole in your financial foundation. No matter how much you invest, if you are carrying significant debt, especially from credit cards or personal loans, your financial growth will be slow. High-interest debt can quickly erode any investment gains you make, leaving you in a cycle of financial instability. Paying off debt should be a priority before aggressively investing. Consider this. If your credit card charges an interest rate of 20% per year, any investment that offers a return lower than this is effectively a loss. You are paying more in interest than you are earning through investments. This is why eliminating high-interest debt is one of the smartest financial moves you can make. Once your high-interest debts are cleared, you can redirect that money toward building wealth rather than paying lenders. As you work towards financial stability, setting realistic financial goals becomes the next essential step. Many people dream of financial freedom, but without clear and achievable goals, it remains just that, a dream. Financial goals give you direction and motivation, helping you stay focused on your long-term aspirations. Whether you aim to buy a house, retire early, or travel the world, having specific goals ensures that you are taking deliberate steps toward achieving them. When setting financial goals, it is important to be both ambitious and practical. Break down your objectives into short-term, medium-term, and long-term goals. Short-term goals could include saving for a vacation or paying off a credit card balance. Medium-term goals might involve purchasing a home or starting a business. Long-term goals often focus on retirement planning and wealth accumulation. By categorizing your goals, you can create a strategy that aligns with your income, expenses, and future aspirations. Another key aspect of goal setting is ensuring that your goals are measurable. Instead of saying, "I want to save more money," define a specific amount and timeline. For example, I want to save $5,000 within a year by setting aside $400 each month. This approach allows you to track progress and make adjustments if necessary. Additionally, revisiting your goals periodically ensures that they remain relevant as your financial situation evolves. Building a solid financial foundation requires discipline, patience, and a clear understanding of your financial priorities. Budgeting gives you control over your money. An emergency fund provides security. Paying off high-interest debt eliminates financial stress, and setting realistic goals ensures steady progress. These steps are not just about money management. They're about creating a future where you have the freedom to invest without fear, knowing that your financial base is strong and secure. Investing is not just about making money. It is about securing your financial well-being. By taking the time to lay a strong foundation, you are setting yourself up for long-term success. When your financial house is built on solid ground, you can weather any storm and confidently move toward financial independence. Now that you have established the importance of a strong financial foundation, the next step is to explore different investment options and strategies that will help you grow your wealth. But remember, the strength of any investment journey lies in the foundation on which it stands. Take the time to build it right, and your future self will thank you. Chapter 5. Stock Market 101, A Beginner's Guide. The stock market has long been a source of wealth and financial growth, yet for many beginners, it remains a complex and intimidating subject. The idea of investing in stocks often brings a mix of excitement and anxiety. Some see it as a golden opportunity, while others fear the risk of losing their hard-earned money. However, once you understand how the stock market works and how to make informed decisions, it can become a powerful tool for building long-term wealth. At its core, the stock market is a marketplace where investors buy and sell shares of publicly traded companies. When you buy a stock, you are purchasing a small ownership stake in that company. As the company grows and becomes more profitable, its stock price generally increases, allowing investors to sell their shares at a higher price than they paid. Conversely, if a company struggles, its stock price may fall, leading to potential losses for investors. One of the most important aspects of stock market investing is knowing how to choose the right stocks. It is easy to get caught up in market hype, but smart investing requires a deeper understanding. Before investing in a stock, it is crucial to analyze the company's financial health, leadership, and growth potential. A company with strong revenue, low debt, and a solid business model is more likely to provide steady returns over time. Additionally, understanding key financial metrics such as earnings per share, EPS, price to earnings, PE, ratio, and dividend yield can help investors gauge a company's profitability and valuation. Market trends and economic factors also play a significant role in stock performance. The stock market is influenced by a variety of factors, including interest rates, inflation, economic growth, and even political events. For instance, when the economy is strong, businesses tend to perform well, leading to higher stock prices. Conversely, during economic downturns, stock prices may decline as businesses struggle to maintain profits. Understanding these trends can help investors make better decisions about when to buy or sell stocks. Many beginners wonder whether they should invest in individual stocks or opt for ETFs, exchange-traded funds, and index funds. Investing in individual stocks can be rewarding, but it requires significant research and time. Individual stocks are subject to higher volatility, meaning their prices can fluctuate greatly in a short period. This can lead to both significant gains and substantial losses. On the other hand, ETFs and index funds offer a more diversified approach to investing. These funds pool money from multiple investors to buy a broad selection of stocks, reducing the risk associated with investing in a single company. For beginners looking for a more stable way to invest, ETFs and index funds can be a great starting point. Understanding risk tolerance is also essential when investing in the stock market. Each investor has a different level of comfort with risk, and it is important to align investment choices with personal financial goals. Some investors are comfortable with high-risk investments that offer the potential for large returns, while others prefer a more conservative approach with steady, reliable gains. Identifying your risk tolerance can help you choose investments that match your financial objectives and reduce the likelihood of panic during market fluctuations. Another crucial factor in successful investing is having a long-term perspective. The stock market will always experience ups and downs, but history has shown that, over time, it tends to rise. Investors who stay patient and committed to their financial goals are more likely to see positive returns in the long run. Short-term market fluctuations can be unsettling, but those who remain focused on long-term growth can benefit from compounding returns, where their investments generate earnings that are reinvested to create even greater wealth. Stock market investing is not just about making money. It is also a journey of personal growth. It teaches patience, discipline, and financial responsibility. As you begin your investment journey, remember that every successful investor started as a beginner. The key is to stay informed, make well-researched decisions, and remain committed to your financial future. By understanding how the stock market works, choosing the right investments, and maintaining a long-term perspective, you can take control of your financial destiny and build a prosperous future. Chapter 6: Real Estate Investing for Beginners. Investing in real estate is one of the most time-tested ways to build wealth. Unlike other investment options that can be volatile and unpredictable, real estate offers stability, long-term appreciation, and multiple income-generating opportunities. Many of the world's wealthiest individuals have built their fortunes through real estate, making it a compelling option for anyone looking to create financial security and passive income. While the process may seem overwhelming to beginners, understanding the fundamentals can help you make smart decisions and leverage real estate as a powerful investment tool. One of the biggest advantages of real estate investing is its ability to generate consistent income. Unlike stocks or bonds that fluctuate daily, a well-selected property can provide stable rental income, serving as a steady revenue stream. This can be especially beneficial for those looking to supplement their primary income or build a safety net for financial freedom. Additionally, real estate properties tend to appreciate over time, meaning their value increases, allowing you to grow your wealth steadily. Beyond income generation and appreciation, real estate also offers tax advantages that other investments may not. Deductions on mortgage interest, property taxes, and maintenance expenses can reduce your taxable income. Additionally, if you hold onto your investment for the long term, you may qualify for capital gains tax benefits when selling, making it a tax-efficient way to accumulate wealth. Leveraging financing is another advantage unique to real estate. Unlike stocks, where you typically need the full amount upfront, real estate allows you to use borrowed money to purchase property, meaning you can invest with less capital while benefiting from the full value of the asset. However, before diving into real estate investing, it is crucial to know how to evaluate a good investment. Not all properties are created equal, and making the wrong choice can lead to financial losses. The first factor to consider is location. A property in a desirable area with access to amenities, schools, transportation, and job opportunities will always be in demand, making it easier to rent or sell. Additionally, market research is essential. Understanding the trends in a particular area, including property values, rental demand, and economic conditions, will help you make informed decisions. A thriving market will ensure that your investment appreciates over time and attracts tenants willing to pay competitive rent. Another important factor is cash flow. A property should generate positive cash flow, meaning the rental income should exceed the expenses associated with owning and maintaining it. Before making a purchase, calculate all the costs, including mortgage payments, property taxes, insurance, maintenance, and management fees. If the income does not comfortably cover these expenses, it may not be the right investment. It is also wise to consider the property's condition and potential repair costs. A fixer-upper may be appealing due to its lower purchase price, but extensive renovations can eat into profits and cause delays in generating income. Real estate investing comes in different forms, and understanding the difference between active and passive investing is essential when choosing the right approach for you. Active real estate investing involves direct involvement in buying, managing, and maintaining properties. This can include purchasing rental properties, flipping houses, or developing land. While active investing often yields higher returns, it requires significant time, effort, and expertise. Investors need to manage tenants, oversee repairs, and handle property-related issues, making it a hands-on commitment. On the other hand, passive real estate investing allows individuals to earn income without the day-to-day responsibilities of managing properties. This can be done through real estate investment trusts, REITs, crowdfunding platforms, or partnerships with experienced investors. REITs, for example, allow investors to buy shares in a portfolio of real estate assets, earning dividends without dealing with tenants or property management. While passive investing offers convenience and diversification, the returns may be lower compared to direct ownership, as management fees and operational costs reduce overall profits. For those who prefer direct ownership, rental properties are one of the most effective ways to build consistent income through real estate. Whether you choose residential, commercial, or vacation rentals, owning rental properties provides a steady cash flow that can grow over time. The key to success in rental property investing is selecting the right tenants, maintaining the property, and ensuring that the rental income covers expenses while generating profit. A well-managed rental property not only produces income but also builds equity as tenants essentially pay down your mortgage over time. Long-term rentals offer stability and predictable income, but short-term rentals through platforms like Airbnb can sometimes yield higher returns. However, short-term rentals require more active management, including frequent cleaning, guest communication, and fluctuating occupancy rates. Investors must also consider local regulations, as some cities have restrictions on short-term rentals. Whether choosing long-term or short-term rentals, conducting thorough research on rental demand, competition, and market trends will help maximize profitability. Chapter 7. Mastering Mutual Funds and ETFs. Investing can seem overwhelming, especially with so many options available. For many investors, mutual funds and exchange-traded funds, ETFs, provide a structured and effective way to grow wealth while reducing risk. Understanding these investment vehicles is a crucial step toward financial security, as they allow investors to diversify their portfolios without the stress of selecting individual stocks. Mutual funds and ETFs are professionally managed pools of money that invest in a variety of assets, such as stocks, bonds, and other securities. They are designed to provide exposure to different market sectors, industries, or asset classes, making them a convenient choice for those looking to build wealth steadily. The main difference between the two lies in how they are traded. Mutual funds are bought and sold at the end of the trading day at their net asset value, NAV, while ETFs trade like individual stocks on an exchange, meaning their prices fluctuate throughout the day. One of the most critical decisions in investing is choosing between active and passive investing strategies. Active mutual funds are managed by professionals who aim to outperform the market by carefully selecting investments. This hands-on approach often involves extensive research and analysis, with fund managers adjusting holdings based on market conditions. While the potential for higher returns exists, actively managed funds typically come with higher fees. On the other hand, passive investing, often associated with index funds and ETFs, aims to mirror the performance of a specific market index, such as the S&P 500. Because passive funds require less management, they usually have lower costs and tend to perform well over the long run, making them a popular choice for many investors. Selecting the right mutual funds and ETFs for your portfolio requires careful consideration of several factors. An investor should evaluate their financial goals, risk tolerance, and time horizon before making any decisions. Expense ratios, which represent the annual fees charged by funds, play a crucial role in overall returns. Lower fees can significantly impact long-term gains, making cost-efficient funds more attractive. Additionally, historical performance and the fund's holdings provide valuable insights into how a fund is likely to behave in different market conditions. While past performance does not guarantee future results, it helps investors assess consistency and management quality. Diversification is the cornerstone of successful investing, and mutual funds and ETFs make it easier to achieve. Instead of putting all of your money into a single stock or sector, these funds spread investments across multiple assets, reducing the impact of poor-performing securities on an overall portfolio. A well-diversified investment approach minimizes risk and enhances long-term stability. For instance, a fund that includes both domestic and international stocks, along with bonds, offers a balanced approach to wealth building. This diversification ensures that even if one sector experiences a downturn, other assets within the portfolio can help offset losses. Many investors underestimate the emotional aspect of investing. The stock market's ups and downs can lead to impulsive decisions that may hurt long-term success. Mutual funds and ETFs help mitigate these emotional reactions by providing a level of stability and structure. Instead of constantly monitoring individual stocks, investors can trust in the diversified nature of these funds, allowing them to focus on their financial goals without unnecessary stress. Mastering mutual funds and ETFs is a journey of patience and learning. The key is to stay informed, make educated decisions, and remain committed to long-term growth. Investing should not be about chasing quick gains, but rather about building sustainable wealth over time. With the right mindset and a well-structured portfolio, mutual funds and ETFs can be powerful tools in creating financial freedom and achieving lasting success. Chapter 8. Retirement Planning. Investing for the long term. Retirement may seem like a distant goal, especially for those who are just starting their financial journey, but the reality is that the sooner you begin planning for it, the better. Many people put off retirement planning, assuming they will have time to figure it out later. However, delaying this crucial aspect of financial security can lead to unnecessary stress and missed opportunities. The key to a comfortable retirement is not just about how much you earn, but how wisely you invest and manage your money over the years. Understanding the importance of long-term investing and making informed decisions today will set the stage for a future where financial stability is within your reach. One of the most powerful tools in retirement planning is tax-advantaged accounts. These accounts, such as 401k, ERAs, and Roth ERAs, offer individuals the opportunity to grow their savings with tax benefits that can maximize their returns over time. A 401k plan, typically offered by employers, allows you to contribute pre-tax income, reducing your taxable earnings and helping your money grow tax-deferred until retirement. Many employers even offer matching contributions, essentially giving you free money to boost your savings. ERAs, on the other hand, come in two main types, traditional and Roth. A traditional ERA provides tax-deferred growth, meaning you pay taxes only when you withdraw funds in retirement. In contrast, a Roth ERA allows for tax-free withdrawals in retirement as contributions are made with after-tax income. Understanding how these accounts work and taking advantage of their benefits can make a significant difference in your long-term financial success. A common question many people have is how much they should invest for retirement. While there is no universal answer, financial experts often recommend saving at least 15% of your annual income. This percentage can vary depending on factors such as your lifestyle, expected expenses, and retirement goals. A good way to determine an appropriate savings target is to estimate your future living costs. Consider housing, healthcare, travel, and other personal expenses that may arise in retirement. The earlier you start saving, the less you need to contribute each year to reach your goal. Compound interest is one of the most powerful forces in investing, and it rewards those who start early by allowing their money to grow exponentially over time. Creating a long-term investment plan is essential for ensuring that your retirement savings are on track. A well-structured plan includes diversifying investments across different asset classes, such as stocks, bonds, and real estate, to mitigate risks and optimize returns. Stocks provide growth potential, bonds offer stability, and real estate can serve as an additional source of income. As you progress through different life stages, adjusting your investment strategy becomes necessary. Younger investors may choose a more aggressive portfolio with higher exposure to stocks, while those nearing retirement might prefer a more conservative approach with a greater emphasis on bonds and fixed income assets. Another important factor in retirement planning is managing risk. Market fluctuations are inevitable, and economic downturns can impact investment portfolios. However, a well-diversified strategy combined with a long-term perspective helps minimize the effects of short-term volatility. Staying committed to your investment plan and avoiding emotional decision-making during market declines is crucial. Many investors make the mistake of selling assets in response to temporary downturns, which can significantly harm long-term returns. Patience and consistency in following a disciplined investment approach are key to building a solid retirement fund. While retirement planning may seem complex, breaking it down into simple, actionable steps makes it more manageable. Begin by setting clear financial goals, determining how much you need to save, and choosing the right investment vehicles. Regularly reviewing your progress and making necessary adjustments will keep you on track. Seeking professional advice from a financial planner can also provide valuable insights and help tailor a strategy that aligns with your unique needs and objectives. Chapter 9. Investing in cryptocurrency, risks and rewards. The world of investing has changed dramatically over the past decade, and one of the most talked about innovations in modern finance is cryptocurrency. While traditional investments like stocks, bonds, and real estate have been around for centuries, digital assets such as Bitcoin and Ethereum have introduced a new frontier filled with both incredible opportunities and significant risks. Understanding how cryptocurrency works, what drives its volatility, and how to approach it safely is crucial for any investor looking to diversify their portfolio with digital assets. Cryptocurrency is a form of digital money that operates on decentralized networks using blockchain technology. Unlike government-issued currencies, cryptocurrencies are not controlled by any central authority, making them borderless and resistant to manipulation. Bitcoin, the first and most well-known cryptocurrency, was created in 2009 by an anonymous entity known as Satoshi Nakamoto. It was designed as a peer-to-peer payment system free from banks and intermediaries. Over time, Bitcoin evolved beyond its original purpose and is now widely regarded as a store of value, often referred to as digital gold. Ethereum, another major player in the cryptocurrency market, introduced the concept of smart contracts, self-executing agreements that operate on its blockchain. This innovation paved the way for decentralized applications, dApps, and various projects, including decentralized finance, DeFi, and non-fungible tokens, NFTs. Beyond Bitcoin and Ethereum, thousands of other cryptocurrencies, known as altcoins, exist, each with different use cases, goals, and levels of risk. One of the defining characteristics of cryptocurrency is its extreme volatility. Unlike traditional assets, which tend to move at a more predictable pace, cryptocurrencies can experience rapid price fluctuations within hours or even minutes. Several factors contribute to this volatility, including market speculation, regulatory changes, technological advancements, and overall adoption. While some investors have made substantial gains, others have faced devastating losses due to sudden price drops. Understanding and accepting this volatility is essential for anyone considering investing in digital assets. Given the potential rewards and risks, investing in cryptocurrency requires careful planning and a disciplined approach. Unlike traditional stocks, which are regulated by financial authorities, the crypto market operates with fewer safeguards, making due diligence even more critical. One of the best ways to start is by educating oneself on different cryptocurrencies, understanding their underlying technology, and researching the teams behind them. Investing only what one can afford to lose is a golden rule in this space, as prices can swing dramatically in either direction. Security is a major concern in the cryptocurrency world. Since digital assets exist only in electronic form, they are susceptible to cyber threats such as hacking and fraud. Storing cryptocurrency safely is essential to protect investments. Many investors use digital wallets, which come into forms hot wallets and cold wallets. Hot wallets are connected to the internet and provide easy access for trading, but they are also more vulnerable to hacking. Cold wallets, on the other hand, are offline storage options that offer greater security by keeping assets away from potential cyber attacks. Additionally, using strong passwords, enabling two-factor authentication, and being cautious of phishing scams are essential steps in safeguarding investments. Crypto scams are another serious risk that investors must be aware of. Ponzi schemes, fake ICOs, initial coin offerings, and phishing attacks have tricked many unsuspecting individuals into losing their money. Scammers often promise unrealistic returns, urging people to invest quickly before missing out on a big opportunity. Conducting thorough research before investing in any new cryptocurrency project is crucial. Checking for legitimate development teams, white papers, and transparent roadmaps can help investors avoid falling victim to fraud. Despite the risks, cryptocurrency continues to gain mainstream acceptance. Large companies and institutional investors are increasingly showing interest in digital assets, and some governments are working on regulatory frameworks to integrate cryptocurrencies into the financial system. With advancements in blockchain technology and broader adoption, the potential for long-term growth remains significant. However, as with any investment, it is important to approach cryptocurrency with a strategic mindset, understanding both the rewards and the challenges that come with it. Investing in cryptocurrency is not just about making quick profits. It is about understanding an evolving financial landscape and deciding whether digital assets align with one's overall investment strategy. While the market remains unpredictable, knowledge, caution, and a well-thought-out approach can make all the difference in navigating this exciting yet risky world. Whether choosing to invest a small portion or taking a more active role, the key lies in staying informed, making rational decisions, and never investing more than what one is prepared to lose. The future of cryptocurrency remains uncertain, but for those who take the time to understand it, the potential rewards can be worth the risks. Chapter 10: How to Minimize Risk and Maximize Returns. Investing is an exciting journey, but it comes with its share of uncertainties. While risk is an inherent part of investing, successful investors understand how to manage it effectively to maximize their returns. Achieving financial success does not mean avoiding risk entirely, but learning how to navigate it wisely. The key lies in making strategic decisions that balance potential gains with the ability to weather market fluctuations. A disciplined approach to investing ensures that wealth accumulation happens steadily over time without exposing oneself to unnecessary losses. One of the most fundamental principles of risk management is diversification. Relying too heavily on a single asset or investment class can be a dangerous strategy, as it leaves investors vulnerable to drastic downturns in that specific market. Spreading investments across various asset types, such as stocks, bonds, real estate, and commodities, helps reduce the impact of volatility. Each asset class reacts differently to economic conditions, which provides a safety net when one sector underperforms. Diversification is not just about having multiple investments, but selecting ones that complement each other, creating a balanced portfolio that can withstand different market cycles. Another powerful strategy to minimize risk while maximizing returns is dollar-cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, an investor purchases more shares when prices are low and fewer shares when prices are high, leading to an overall lower average cost per share over time. This method removes the emotional aspect of market timing and ensures consistent contributions toward long-term financial goals. It also reduces the likelihood of making rash decisions based on short-term market movements, fostering a more disciplined approach to investing. Understanding market cycles is crucial for making informed investment decisions. Markets move through different phases, including expansion, peak, contraction, and recovery. Recognizing these cycles helps investors determine when to buy and when to hold or sell their assets. While it is impossible to predict market movements with complete accuracy, having an awareness of historical trends and economic indicators can provide valuable insights. Investors who understand these cycles can position themselves advantageously rather than reacting impulsively to market noise. The key is to remain patient and trust the process rather than chase quick profits that often lead to higher risks. One of the greatest challenges in investing is managing emotions. Many investors fall into the trap of letting fear and greed dictate their decisions. Fear often leads to panic selling when markets decline, while greed can result in reckless buying when prices soar. Staying emotionally detached from investments is a skill that separates successful investors from those who struggle. Developing a long-term perspective helps investors ride out temporary downturns without making impulsive choices. A well-structured investment plan based on research and strategy allows for confidence in the face of market volatility. To cultivate emotional discipline, investors should focus on their long-term financial goals rather than short-term fluctuations. Setting clear objectives and following a consistent investment strategy provides a sense of stability even during uncertain times. Avoiding constant market monitoring and resisting the urge to react to daily news can help maintain a rational approach to investing. Seeking guidance from financial advisors or engaging with a community of like-minded investors can also provide reassurance and prevent emotionally driven decisions. Investing is a journey that rewards patience and knowledge. By implementing strategies such as diversification, dollar-cost averaging, and understanding market cycles, investors can create a resilient portfolio that grows over time. The ability to remain emotionally detached from market fluctuations ensures that decisions are based on logic rather than fear. Ultimately, successful investing is not about chasing short-term gains, but building a solid financial foundation that stands the test of time. With the right mindset and a strategic approach, anyone can navigate the world of investing with confidence and achieve long-term financial success. Chapter 11: Passive Income: Making Money While You Sleep. Imagine waking up in the morning, checking your bank account, and seeing that money has been deposited overnight without you lifting a finger. This is the power of passive income. It is the ability to earn money with little to no daily effort, allowing you to focus on other aspects of life while your investments and assets continue to generate revenue. While active income requires continuous effort, like working a 9-to-5 job or running a business, passive income enables financial freedom, reduces dependence on a paycheck, and builds long-term wealth. One of the most popular ways to generate passive income is through dividend investing. When you invest in dividend-paying stocks, you are essentially buying ownership in a company that shares its profits with investors. Instead of selling your shares to make a profit, you receive regular payments just for holding them. Many blue-chip companies, such as those in the energy, financial, and consumer goods sectors, offer consistent dividends. The beauty of this approach is that reinvesting dividends can lead to compounding growth over time, where your earnings generate even more earnings. Over the years, a well-structured dividend portfolio can provide a steady income stream, making it a powerful tool for financial independence. Beyond stocks, another modern way to build passive income is by creating digital assets. With the rise of the internet, individuals now have the opportunity to generate revenue through online content. Writing ebooks, developing online courses, and creating valuable digital products can serve as long-term income sources. Unlike traditional businesses that require constant management, digital assets can be created once and sold repeatedly without significant ongoing effort. If you are an expert in a particular subject, packaging your knowledge into an ebook or an online course allows you to reach thousands, if not millions, of people, all while earning passive income. Content creators on platforms like YouTube and blogs also monetize their work through ad revenue and sponsorships, providing yet another avenue for financial growth. In addition to stocks and digital assets, there are several other sources of passive income that can contribute to a diversified financial strategy. Real estate investment trusts, REITs, offer a way to invest in real estate without the hassle of property management. These publicly traded companies own and manage income-generating properties such as shopping centers, office buildings, and apartments. By investing in REITs, individuals can earn regular dividends from rental income collected by these companies. Peer-to-peer lending is another option, where investors provide loans to individuals or businesses in exchange for interest payments. While this method carries some risks, careful selection of lending platforms and borrowers can lead to consistent returns. Royalties from intellectual property can also be a powerful source of passive income. Musicians, authors, and inventors earn money from their creative work long after the initial effort has been made. Licensing a book, a song, or a patent can generate ongoing income for years. With the expansion of digital distribution platforms, creators today have more opportunities than ever to profit from their talents. The key to achieving financial success through passive income is patience and persistence. Unlike active income, which provides immediate rewards for effort, passive income takes time to build. It requires an initial investment of money, time, or creativity, but the long-term benefits are invaluable. Whether through dividends, digital products, real estate investments, or royalties, building passive income is one of the most effective strategies for attaining financial freedom. Those who embrace this concept understand that wealth is not just about working harder, it is about working smarter. While traditional jobs and businesses play an essential role in financial stability, the ability to generate income passively allows people to live life on their own terms. It provides the freedom to travel, spend time with loved ones, and pursue passions without constantly worrying about money. The journey to passive income may not be instantaneous, but the rewards are well worth the effort. By strategically incorporating different income streams and allowing them to grow over time, financial independence becomes not just a dream, but a reality. Chapter 12. The Art of Smart Spending and Saving. Smart spending and saving are at the core of financial success. Every dollar spent today impacts your financial future, shaping your ability to invest, grow wealth, and ultimately live a life of financial freedom. Understanding the psychology behind spending can help create a healthier relationship with money, ensuring that financial decisions align with long-term goals rather than short-term impulses. Many people fall into the trap of emotional spending, buying things they don't need simply because of momentary happiness or external pressures. It is crucial to recognize these patterns and shift towards intentional spending. Every purchase should have a purpose, adding value to your life rather than draining your resources. This conscious approach to spending is what separates financially stable individuals from those who constantly struggle with money. One of the simplest yet most effective budgeting methods is the 50-30-20 rule. This method allows for balanced financial management by allocating income in a way that ensures stability while leaving room for personal enjoyment and future growth. The idea is to dedicate 50% of your income to essential needs such as housing, utilities, and food. These are the necessary expenses that keep life running smoothly. The next 30% is allocated to discretionary spending, covering non-essential but enjoyable aspects of life, such as entertainment, dining out, or hobbies. Finally, 20% of income should be directed towards savings and investments, ensuring that financial security continues to grow over time. While budgeting is essential, it is equally important to practice mindful spending. This means prioritizing quality over quantity, ensuring that each purchase serves a meaningful purpose. Instead of buying multiple inexpensive items that may not last, it is wiser to invest in high-quality products that provide long-term value. This principle applies to everything from clothing and technology to larger financial commitments such as housing and vehicles. Mindful spending prevents waste and contributes to a more financially sustainable lifestyle. One of the most powerful financial strategies is automating savings and investments. Setting up automatic transfers to a savings account or investment portfolio eliminates the risk of forgetting or spending money impulsively. Automation ensures consistency in financial growth, making wealth accumulation an effortless process. Over time, these small, consistent savings can turn into substantial financial assets, providing security and freedom. Developing smart spending and saving habits is a crucial step toward long-term financial success. By understanding the impact of spending choices, following a structured budgeting method, practicing mindful purchasing, and automating financial contributions, anyone can achieve stability and growth. Financial well-being is not about how much money is earned, but rather how wisely it is managed. The key to building wealth is not just making money, but making money work for you through intentional decisions and disciplined financial habits. Chapter 13. Taxes and Investments. What you need to know. Taxes play a crucial role in shaping an investor's journey, yet they are often overlooked or misunderstood. Knowing how taxes impact investments can make the difference between keeping more of your hard-earned money or losing a significant portion of your gains to the government. Understanding the tax landscape, learning strategies to minimize liabilities, and avoiding common mistakes can help you build and protect your wealth more effectively. One of the most important aspects of taxation in investing is capital gains. When you sell an investment for more than you paid for it, the profit you earn is called a capital gain. This gain is categorized as either short-term or long-term. If you hold an investment for a year or less before selling, the profit is considered a short-term capital gain, which is typically taxed at a higher rate, similar to ordinary income. On the other hand, long-term capital gains, profits from investments held for more than a year, are taxed at a lower rate, making them a more tax-efficient way to build wealth over time. Many investors make the mistake of frequently buying and selling stocks without considering the tax implications, leading to unnecessary short-term capital gains taxes that reduce their overall profits. Tax-efficient investing is a strategy used to minimize the amount of taxes owed on investment gains. One effective way to do this is through tax loss harvesting, a method where investors sell underperforming assets to offset gains from winning investments. By strategically realizing losses, investors can reduce their taxable income and reinvest in similar assets to maintain their market position. Another key strategy is asset location, placing tax-efficient investments like ETFs and municipal bonds in taxable accounts while keeping tax-heavy investments like bonds and actively managed funds in tax-advantaged accounts. By structuring investments wisely, investors can significantly cut down their annual tax bills and allow more of their money to compound over time. Speaking of tax-advantaged accounts, these financial vehicles offer powerful ways to grow wealth while minimizing tax liabilities. Accounts like 401(k), S, IRAs, and Roth IRAs provide different tax benefits that investors can leverage. Traditional 401(k), S, and IRAs allow investors to contribute pre-tax income, reducing their taxable income in the year of contribution, while Roth accounts use after-tax dollars, making withdrawals tax-free in retirement. Each of these accounts serves a purpose depending on an investor's financial situation, income level, and future tax expectations. Utilizing these accounts properly can help investors build a strong financial foundation and reduce the tax burden on their retirement savings. Despite the availability of tax-saving strategies, many investors fall into common tax traps that can cost them thousands of dollars. One of the most frequent mistakes is failing to account for taxes when rebalancing a portfolio. When investors adjust their holdings to maintain a desired asset allocation, they may unknowingly trigger capital gains taxes if they sell assets in taxable accounts. Another common misstep is ignoring the required minimum distributions, RMDs, from tax-deferred accounts like 401(k), S, and traditional IRAs. Once investors reach the age of 73, they must withdraw a certain amount each year, and failing to do so can lead to hefty penalties. Additionally, some investors make the mistake of not considering estate taxes when passing down their investments to heirs. Without proper planning, beneficiaries may face unexpected tax bills that could diminish their inheritance. Navigating the tax implications of investing can seem overwhelming, but understanding the fundamentals and implementing smart strategies can help investors keep more of their wealth. Taxes should never be an afterthought in an investment plan. Instead, they should be factored into every financial decision. With the right knowledge and preparation, investors can ensure that taxes work for them rather than against them, ultimately leading to greater financial success and long-term wealth preservation. Chapter 14. Mastering the Investor Mindset. Investing is not just about numbers and financial strategies. It is also about mindset. The ability to stay calm in turbulent markets, make rational decisions, and think long-term is what separates successful investors from the rest. The investor mindset is not something you are born with, but something you cultivate over time. It requires discipline, patience, and the ability to control emotions such as fear and greed. Patience is one of the most valuable traits of a successful investor. The stock market does not reward those who chase quick profits or panic at the first sign of trouble. Instead, it favors those who understand that wealth building is a long-term game. Many of the world's greatest investors, including Warren Buffett and Charlie Munger, have emphasized the importance of patience in achieving financial success. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." This statement highlights the core principle of long-term investing, staying invested despite market fluctuations. Patience allows investors to let their investments grow over time, taking advantage of compound interest and the overall upward trajectory of the market. One of the biggest challenges investors face is controlling their emotions. Fear and greed are two emotions that can derail even the most well-thought-out investment plan. When the market is soaring, greed tempts investors to take excessive risks, chase speculative stocks, and ignore fundamental investment principles. On the other hand, fear can cause investors to panic and sell at the worst possible time when markets are down. Understanding these emotions and learning to manage them is critical to developing a successful investor mindset. Successful investors approach the market with a rational and unemotional perspective. They do not let short-term market fluctuations dictate their actions. Instead, they focus on the long-term value of their investments. One way to control emotions is by having a solid investment plan and sticking to it. When you have a well-diversified portfolio and a clear strategy, it becomes easier to stay focused during market volatility. Additionally, staying informed and continuously learning about investing can help reduce emotional reactions. Knowledge provides confidence, and confidence helps investors make better decisions. Learning from successful investors can provide valuable insights into mastering the investor mindset. Warren Buffett and Charlie Munger are two of the most respected investors in history, known for their disciplined approach and long-term thinking. Buffett believes in investing in businesses, not just stocks. He focuses on companies with strong fundamentals, competitive advantages, and long-term growth potential. Munger, Buffett's longtime partner, emphasizes the importance of mental models and rational thinking. He encourages investors to think critically, avoid biases, and approach investing with a logical mindset. Buffett and Munger's success is built on patience, discipline, and a deep understanding of businesses. They do not chase trends or get influenced by market noise. Instead, they stick to their principles and invest in companies they believe in for the long run. Studying their strategies can help investors develop a similar approach, focusing on sustainable wealth building rather than short-term gains. Developing a long-term perspective is essential for achieving financial success. Many investors get caught up in short-term market movements and fail to see the bigger picture. The key to long-term investing is understanding that the market will have ups and downs, but historically, it has always trended upward over time. Those who stay invested and avoid making impulsive decisions tend to see the best returns. One way to develop a long-term perspective is by shifting the focus from daily stock prices to business fundamentals. Instead of checking stock prices every day, investors should analyze a company's financial health, growth potential, and industry position. By concentrating on long-term value rather than short-term fluctuations, investors can make more informed decisions and avoid unnecessary stress. Another important aspect of long-term investing is setting realistic expectations. No investment will provide overnight wealth, and expecting quick returns often leads to disappointment. A well-thought-out investment strategy takes time to yield results. Understanding this principle helps investors stay patient and committed to their financial goals. The investor mindset is a powerful tool that determines success in the world of investing. Mastering patience, controlling emotions, learning from successful investors, and developing a long-term perspective can significantly improve investment outcomes. By adopting these principles, investors can build wealth steadily and avoid the common pitfalls that often lead to financial losses. Investing is not about making quick profits. It is about making smart, informed decisions that pay off over time. Those who cultivate the right mindset will find themselves in a strong position to achieve financial independence and long-term success. Chapter 15: Creating your personalized investment plan. Creating a personalized investment plan is the key to achieving financial freedom and building lasting wealth. Every investor has unique goals, risk tolerance, and financial circumstances, which means that a one-size-fits-all approach simply does not work. The journey to financial success starts with understanding where you are today, where you want to be in the future, and the steps you need to take to get there. The first step in crafting a successful investment plan is assessing your financial goals. Some people invest to secure a comfortable retirement, while others aim to grow their wealth for major life expenses such as buying a home, funding a child's education, or even starting a business. Clearly defining these goals will provide direction and purpose for your investments. Without a clear objective, it is easy to get lost in the ups and downs of the market, reacting emotionally to short-term fluctuations rather than staying focused on long-term growth. Understanding your risk tolerance is just as crucial as setting goals. Risk tolerance refers to your ability and willingness to endure fluctuations in the value of your investments. Some people are naturally comfortable with market volatility, while others feel uneasy when they see their portfolio decline in value. Knowing your risk tolerance helps in choosing the right assets that align with your comfort level. If you have a low tolerance for risk, conservative investments like bonds or dividend-paying stocks may be more suitable. On the other hand, if you have a long investment horizon and can handle short-term volatility, growth stocks and more aggressive assets might be a better fit. The key is finding a balance that allows you to stay invested without feeling overwhelmed by market swings. Once you have established your goals and risk tolerance, the next step is building a diversified portfolio. Diversification is the practice of spreading your investments across various asset classes to reduce risk. A well-diversified portfolio includes a mix of stocks, bonds, real estate, and other investment vehicles. The idea is that when one asset class underperforms, another may perform well, helping to smooth out overall returns and minimize losses. For example, if the stock market experiences a downturn, having investments in bonds or real estate can help cushion the impact. Diversification does not guarantee profits, but it is a powerful strategy to manage risk and create a more stable investment journey. Reviewing and adjusting your investments over time is essential to maintaining a successful portfolio. Markets change, personal circumstances evolve, and economic conditions fluctuate. This means that an investment strategy that works today may not be suitable in the future. Periodic reviews, whether quarterly or annually, allow you to assess whether your investments are still aligned with your goals. If you experience major life changes, such as marriage, having children, or nearing retirement, you may need to make adjustments to your portfolio to reflect your new financial priorities. Rebalancing ensures that your asset allocation remains in line with your risk tolerance and long-term objectives. A key aspect of successful investing is staying committed to your wealth-building journey. The financial markets will always have ups and downs, but the most successful investors remain disciplined and focused on the long-term picture. Emotional investing, driven by fear or greed, often leads to poor decision-making. During market downturns, some investors panic and sell their assets at a loss only to miss out on potential recoveries. On the flip side, chasing after hot stocks or speculative investments can result in unnecessary risks. Sticking to a well-thought-out investment plan and maintaining a long-term perspective will help you navigate the inevitable market fluctuations with confidence. Education and continuous learning are vital components of successful investing. The financial landscape is constantly evolving, and staying informed about new investment opportunities, market trends, and economic developments will empower you to make better decisions. Reading books, following financial news, and seeking advice from experienced investors or financial advisors can provide valuable insights. The more knowledge you acquire, the more equipped you will be to make informed choices that support your financial goals. Creating a personalized investment plan is not about chasing the latest trends or getting rich overnight. It is about establishing a solid financial foundation and making consistent, strategic decisions that lead to long-term success. By setting clear goals, understanding your risk tolerance, diversifying your portfolio, regularly reviewing your investments, and maintaining a disciplined approach, you can create a path to financial independence. The journey to wealth building requires patience and persistence, but with the right mindset and strategy, financial security and freedom are within reach. Conclusion. As we reach the final chapter of this journey, it is time to take a step back and reflect on what we have learned. Investing is not just about numbers, charts, and strategies. It is about building a foundation for financial freedom and a secure future. You have explored the fundamentals, understood the stock market, learned about different investment vehicles, and discovered how to make informed decisions based on knowledge rather than emotions. Now, the path forward is in your hands. One of the most crucial lessons in investing is the power of consistency and discipline. Success does not come from making impulsive decisions or chasing quick gains. It comes from following a well-structured plan, sticking to your long-term strategy, and staying patient even during market downturns. Wealth building is a marathon, not a sprint. The ability to remain committed to your investment journey through highs and lows will set you apart from those who panic at every market fluctuation. True investors understand that time in the market is more important than timing the market. Along the way, setbacks are inevitable. There will be times when the market experiences volatility, and you might see your investments lose value. At such moments, it is essential to remember that losses are part of the game, and every successful investor has faced challenges. What separates successful investors from the rest is their ability to learn from mistakes and adapt. Perhaps you made an investment based on hype rather than research, or maybe you underestimated risk. Rather than dwelling on these missteps, use them as opportunities for growth. The best investors are those who continuously refine their strategies and make better choices moving forward. Financial independence is the ultimate goal. Imagine a life where your investments generate enough income to support your needs, where you no longer have to trade time for money, and where you have the freedom to pursue your passions without financial stress. This is not an unattainable dream. It is a reality that many have achieved by following the principles you have learned in this book. It begins with setting clear goals, developing a disciplined approach, diversifying wisely, and maintaining a long-term perspective. The earlier you start, the more time your investments have to grow. But remember, it is never too late to begin. The journey to financial freedom requires commitment, but the rewards are life-changing. With every dollar you invest wisely, you are securing a future of possibilities and independence. Now, it is up to you to take action. Revisit your financial goals, reassess your investment strategy, and continue learning. The more you educate yourself, the more confident you will become in making financial decisions. As you move forward, remember that wealth building is not just about accumulating money. It is about creating choices, security, and the ability to live life on your own terms. Stay the course, embrace the lessons you have learned, and keep pushing towards the financial future you deserve. The road ahead is yours to navigate, and with the right mindset and determination, you can achieve true financial independence. Thank you for listening. Like, share, and subscribe to our channel to get updated with upcoming audiobooks. Feel free to ask anything in the comment box.